think that Patrick should give enough people enough time to get settled. Again, I want to say thank you for everybody for logging into our webinar today. For those that are familiar with TaliMar Financial, we are a hard money lender here in San Diego. We also run TaliMar Income Fund 1, which is our mortgage fund. Over the last couple of months, I've been scheduling speakers, guest speakers, who I feel bring a ton of great content to both my investors and my borrowers. I met Patrick at the San Diego Creative Investor Association. It's a local networking event here for real estate investors. So Patrick, thanks for coming on today.
Thanks for having me on, Brock.
Yeah, so we're gonna go ahead and just go through some basic information about TaliMar Financial. We'll go ahead and get Patrick started. Just a quick disclosure, just wanna let you know that this is a presentation. I do not back any information that any of my guest speakers bring. All that information is based upon their knowledge and understanding of where the market is. I do run a mortgage fund, and a lot of the listeners here either invest in or are interested in the mortgage fund. So this is not a solicitation to invest in the fund. If you're interested in investing in the mortgage fund, please reach out to me personally. I'll be more than happy to provide you the offering documents, and you can make a decision at that point. At the end of the day, I just want to say a disclaimer. It is up to you to make appropriate investments for yourself. All right, so real quickly, just what we're going to talk about today is really just jump right into the housing market. I'm interested to hear from Patrick about, how we ended in 2022 and what to expect going into 2023. A ton of volatility in the market, so I'm interested to hear what Patrick has to say. At the end, we'll talk a little about what TaliMar Financial does, both on the investment side, and then also for those real estate investors that are looking for a hard money lender, we'll go ahead and provide you a little guidance on the types of loans that we fund. And then we'll end it with a Q&A. So if you got any questions for Patrick or myself, feel free to submit those questions. For some of you, the question button is at the top of your screen, and at the bottom for others. So real quick, TaliMar Financial, I established TaliMar Financial in 2008. We are a hard money lender. We specialize in funding residential and commercial hard money loans. For many of you, those are fix and flip loans, fix and hold loans, bridge loans. We work specifically with real estate investors, mortgage brokers, real estate agents to provide the short-term financing they need for their real estate investment projects. We are also the manager of TaliMar Income Fund. We are a direct lender, so all the funds that we're lending out are from our own mortgage fund. So people can actually invest in the fund. They act as a limited partner in the fund, and investors earn interest that the fund earns on the loans that we originate. Give you an idea of our background. We've funded since 2008 over 850 loans, totaling over 350 million. In fact, we have roughly 50 million in loans outstanding, primarily here in the San Diego market. So I'm super interested to hear what Patrick has to say about the housing market. So with that, I am going to hand it over to Patrick, and I'm going to let you fly. So I'm going to go ahead and allow you to share the screen now.
All right, sounds good. Can you see my screen, Brock? I got it up here in front of you.
I'm going to go ahead, and there we go. I can see it.
Perfect. All right, so I'm looking at who's online today, and I recognize a couple of names, but not many names. So if it's the first time you've seen one of my presentations, I hope you in this much wiser about the real estate market than what we're beginning at here. We've got about an hour to an hour and a half to cover a lot of data. My presentations are always very data driven, numbers driven, because I always say people can lie, but numbers can't. So quite often you will not get my opinion. You'll just get the raw data, and I'll paint kind of a story, a picture around that data. So with that, let's get into it. A quick background on me. I've been in real estate now for about 15 years, a little over. I own 8 properties all throughout San Diego, small apartment buildings, single family condos, you name it. And I really began investing that decade and a half ago while I was on active duty in the Navy. I've now been in the Navy for 22 years. I still serve in the Navy Reserves 1 week in a month as the officer in charge of a small unit here in San Diego. But when I was on active duty, my 11 years on active duty, a mentor of mine gave me some advice and said, Patrick, buy real estate as often as you can and hold on to it. So every time I went on a military deployment, I came back and I bought some real estate. I would deploy again, come back and buy some real estate, get promoted, buy real estate. And I never sold anything I bought. So now my wife and I were sitting on 8 properties. That doesn't even include various syndications that I've partnered with and I'm a part of throughout the country.
So Patrick, real quick, I just want to say, number one, thank you for your service. All of our listeners, absolutely thank you for your service. And you know that your story is so emblematic of what you can accomplish by investing in real estate. So thank you for sharing.
Yeah, thanks, Brock. And I grew up as a poor kid in the Midwest. I'm from North Dakota. We lost our house when I was a kid due to a medical situation. We had to move, and I know what housing insecurity looks like. So it's crazy to think that some poor kid, you know, my parents couldn't even send me to college, so that's why I joined the Navy. And now I've got millions in real estate. How does that happen? It happens because you got to differentiate yourself by doing one thing, and that's going out there and just doing it. So many people want to do it, but they never get off their couch and actually go out there and buy real estate and make investments. And I started when I was in my 20s. So I got out of the Navy really to start a brokerage team and help other people like me, normal people, mom and pop investors, people in their 20s, people much older, but help people get into the game of real estate investment, because nothing can change your life more, certainly your financial life more, than owning real estate and getting in the game. When I got out of the Navy, you see in the middle there, the education, I went and got a master's degree in real estate right here at the University of San Diego, Master's of Science in Real Estate. Before that, I earned an MBA with a focus in finance from UCLA. And before that, I graduated the U.S. Naval Academy. So with that academic background, my slides, my presentations are always very academic and data driven rather than what you might consider salesy. The awards, you know, I've only been in brokerage about half a decade, but my team and I have earned a lot of awards in those 5 years. We always rank ever since year 1 in the top 1% of real estate teams and agents in San Diego County, and actually also nationally. And just last year, I was recognized by the San Diego Business Journal as one of 50 people in our city, 50 most influential residential real estate professionals. So with that, here's my contact info. If you have any questions after this, I know you got Brock's contact, wanted to put mine up here too. Best way to get a hold of me is always through email, and that's what I got there at the top. I love this picture because it's one of those pictures that says 1,000 words, where a lot of people see a problem. People like me and hopefully people like you see opportunity. In fact, I have made in all of my investments, I have made the most amount of money when people were at the height of fear. Brock, you're shaking your head. Yep.
Yeah. No, I mean, we see it right now in the mortgage fund in terms of from investors. You know, one of the big fears is where the housing market is going. Yeah. And that's just driving returns up in the fund.
You know, in our lifetimes, people probably had a height of fear during the Great Recession, housing crisis. That's when I started putting all my chips on the table and going all in. As Warren Buffett says, when everyone else is fearful, be greedy. And when everyone else is greedy, be fearful. Mm-hmm. That is how I've lived my financial life since I was 8 years old. Mm-hmm. And when I saw the housing crisis of 2006, 7, 8, 9, I was putting all kinds of money into the market. That's when I got into it, started buying stuff up. When the pandemic hit, March 2020, horrible situation. Lots of folks died, lots of folks suffering, lots of jobs lost. And I put that in one segment of my brain. My family actually suffered quite a bit personally because of it. However, I also saw financial opportunity. And it thought me of a quote that goes back to the French Revolution. Buy when there's blood on the street, even when the blood is your own. And that's a Rothschild family that came up with that quote. So March 2020, what did I do? I went out and bought a fourplex on the beach. It was on a fire sale. And fast forward now 2 years, and it's worth $1 million more than what I bought it for. Wow. You make money, not through work. And I talk big money, like real money. You make money by decisions. You make money by decisions, and it's usually really challenging decisions during challenging times. But as long as you have data showing you long-term trends of what's most likely to happen based on your decision, you can make those decisions much more comfortably. So I look at long-term trends. With that, I always say, hey man, nobody can predict tomorrow. Nobody can predict tomorrow, but everybody can predict the next 10, 20, 30 years.
Patrick, I think you make a good point on that. It's like, I look at markets like San Diego and some other urban California markets where you're going to always have a supply demand imbalance. There's nothing you can do about it. And that really is such a great buffer when investing in markets like this, is because there's just never going to be enough supply. I mean, you're never going to really have an oversupply in the market. And I think you see that. You're probably going to get into that, but you're going to see that today. I mean, just the amount of homes for sale is at an all-time low.
Absolutely. And we'll show the raw data where supply versus demand is at. My undergrad degree, I was an English major, so I always like a good thesis statement. And my thesis statement to my presentation today is that San Diego today is San Francisco circa 1990. And just imagine how wealthy you could have been had you went and bought some San Francisco real estate in the 1990s. And maybe some of you did. And if you want to imagine, well, here's a chart that can help you with that imagination. What you see is the gold and black line is San Francisco single family homes and condos, the median sales price just going up to 2018. But what I like to really zoom in on is what happened in the 90s to San Francisco real estate. It exploded in price. And it didn't explode in price all of a sudden because they're building homes better in San Francisco compared to the rest of the country. It exploded in price because of what was happening economically in San Francisco. And you and I both know that the silicon chip, which was relatively new in the 90s, started becoming mass produced. Nobody had a computer in their home in the 80s. By the end of the 90s, everyone had a computer. And it just so happened the powers to be decided that the silicon chip was going to be mass produced in this area now called Silicon Valley, San Francisco, and the Bay Area. And I use this as an example to illustrate that at the end of the day, the value of real estate is most heavily influenced by the economy around that real estate. So when I personally invest in real estate, I inspect the real estate. I hire an inspector, spend half a day looking at the pipes and the electric, but I spend most of my time investigating and researching the economy around that real estate, be it a different city, a different state, or even a different neighborhood in San Diego. You got to know the economy around it. Okay. With that, I also, coming off the thesis, let's cite a few sources. Keeping Current Matters, UCLA Anderson, San Diego Association of Governments, SDAR, the Association of Realtors, California Association, and Reports on Housing. I always like to cite sources, and a lot of stuff you're going to see today might not be on this screen, but I did my best to cite the source on the bottom of each. And not only to give them credit, but also to share with you where you can get data. There's a lot of open source data real estate investors, owners can get free access to. I also love this kind of one-liner. We don't have an interest rate problem. We have a housing inventory problem. Interest rates are artificial, guys. They can go up and down with a push of a button, the turn of a lever, the tweak of a switch, and that's done by the Fed, right? Many other things out there affect interest rates, but they're artificial, created by mankind, and you can't change it. You can change them quickly. What you cannot change quickly is inventory. Inventory and demand, they're both very real, and they're both things that you can't just push a button or flip a switch and all of a sudden we have tons of inventory. It takes a long time. to get inventory onto a market. So I'll share with you a slide that shows, as Brock mentioned, that San Diego lack of supply. And this is really nationwide. It's certainly Southern California wide, and more specifically, San Diego. You see the imbalance here by just how much supply we have built over the last decade plus relative to how much we needed to build. We need 15,000 units to come online per year just to satisfy growing demand within our region. And we've built a fraction of that. We're now short nearly 100,000 units. And I don't care if you're talking about housing, if you're talking about food, cars, Snicker bars, or even cans of beer. If you have less supply than you have demand, the price will go up. If you have more supply than you do demand, the price will go down. If you understand nothing else about economics, that's all you need to really know when it comes to investing in just about anything. So I always like to start my slides by cutting to the punchline. What is the bottom line? What's going to happen? And then we'll get into all this data to back it up. There is not some massive real estate crash on the horizon. The only way to have a real estate crash is to have far too much supply relative to demand. That happened in 2007, 8, and 9 because of poor lending standards. We have had some of the most rock solid lending standards in the history of mankind over the last 10 years because of the Great Recession. So we are no longer built on a house of cards. This housing market today is built on a house of bricks, and it's just not going to crash like we saw 15 years ago. There's not enough real estate supply. That's keeping prices where they're at. And over the long term, real estate prices will keep going up. Rent will keep going up. Now, a lot of times my presentations are to owners, home buyers, potential investors. I know a lot of you are investors, maybe you own some multifamily, and rent will go up, so you don't want to be a renter. But you can also look at this, you want to be a landlord. If you want to own some assets, stocks, bonds, gold, Bitcoin, or real estate, I put most of my money in real estate because I know that is the asset where I'm going to see not only some significant appreciation in the coming years, tax deferred, by the way, but I'm also going to see significant cash flow growth in the coming decades on real estate. Now is still a good time. In fact, now is probably one of the better times to get into real estate. One of the top agents on my team, he sells 40 million a year by himself in real estate. He knows now is a great time to get into it. And he went out and bought himself a triplex just last month. And he convinced his sister to go out there and buy a duplex last month. And he wouldn't be buying real estate himself right now if he thought it was a bad time. But like me, he looks at the data.
I would 100% agree with you on Patrick on that because, number one, if you were to look at real estate, let's just say maybe 12 months, maybe a little more longer, there was so many people going out and attempting to buy that they, houses were going in hours, right? And you couldn't get your offer in. There was no way you were going to win anything. Now you actually have a time to actually look at real estate, decide, okay, what am I going to pay for this piece of real estate, and not be negotiating against yourself just because you couldn't get your offer in quick enough.
Well, and as we like to say, you can always refinance your loan, but you can never refinance your purchase price.
Yep.
And once interest rates get back down in the mid fives again, once they get back in the mid fives, you will see the market go bananas again. Yeah. Right now, buyers got scared. Rates went up in the sevens. They just got unqualified. We're now down around the sixes, low sixes. When we get in the mid fives, you will see a flood of buyers come back in. Again, we've got data to back that up. And you will see prices skyrocket again and hold, because I just don't see the Fed. I don't see us going back up in the sevens again anytime soon. But speaking of interest rates, that's always been the elephant in the room. It's certainly for the last 6 to 9 months. And this is what most people are seeing. They're looking back 10 years and they're like, my gosh, we're at some of the highest rates we've seen in the last decade plus. The reality is I always take the long view. I plan on living until I'm like in my 90s. So I invest for the long view. And also, the longer view you have in any data trend, the more accurate picture you get. That's just data. So let's take that long view. If you take a step back and you look at the last 50 years, even when we were in the sevens and now we're in the sixes, we still are at what I would consider normal, if not relatively historical low rates, but certainly normal. And again, once we get back in the fives, you will see a flood of buyers come back in the market. We still don't have the inventory. Over 90% of San Diego real estate owners have an interest rate of 4% or below. So they're not really incentivized to sell their homes. That'll keep inventory low. Yet when we get in the fives, that's going to be like the strike zone for a lot of these buyers to come in. And you'll see valuations start skyrocketing again. This is a really complex spreadsheet. I'm not going to dive into it too deep, but there's a couple of like surface points I really want you to get a feel for. And you can look at this as an investor. If you're out there buying real estate, certainly if you're going to buy to hold, the power of compounding when it comes to money over time. But also you can look at this as a renter. If you're looking, hey man, should I keep on renting property or should I go buy something right now? And I'm not going to bore you with all the lines and columns, but I do want to zoom in on what you see in green and red. That color chart. So I'm just going to zoom in on that real quick. And I use this as a mathematical example to say, hey, let's look at the 30 years. Let's look at a 30-year time span between someone who's going to rent versus own, or an investor who's going to go buy a property. Let's say you're an investor and you're not going to buy a $5 million building. You just want to buy a $500,000 condo. And you can add as many zeros as you want. You add a zero to the purchase price, just add a zero to everything else. But this example of a 1-bed, 1-bath condo, if someone were to buy it today, $500,000, 6.5% interest rate, $400 a month HOA, $800 a year insurance, and of course you got your taxes, they'd pay about $3,900, almost $4,000 a month in rent. Whereas if you wanted to rent that same condo, you would pay $3,000 a month. Now, most human beings are not that well educated in finance and economics. So most human beings would look at this and they would see on the far right, I can rent this for $3,000 or I can buy it and pay $3,900. They're going to end up renting it. And in the long run, they'll become more poor and less wealthy because of that short-term, short-minded decision. Now, if we look at what happens over 30 years, that renter, assuming their rent goes up 5% a year, which is very realistic here in San Diego, often more, the renter is going to pay 2.39, almost 4 million over 30 years in rent. That owner pays about 1.6 million. You see that circled in red. And at year 31, the owner's payment goes down to $2,000 and the renter's payment goes up to over $12,000. Because when you take $3,000 a month in rent and you compound that by 5% year over year for 30 years, in 30 years, you're now paying a $12,000 rent bill per month. But imagine being the other guy on the other end of the equation, the owner, the landlord. You maybe bought this thinking you're going to negative cash flow $900 a month. And yes, you would that first year of acquisition. But by the time 30 years, man, you're making $12,000 a month and you're only paying $2,000. This is how wealth is built, as you see in the net worth increase. $3 million. You take a $500,000 asset and it grows at 6% year over year appreciating. In 30 years, it's worth $3 million. Tax deferred wealth building. This is what I love about real estate. This is what I've been doing for the last 15 years. Oh, and I ran a little sample too. How high would interest rates have to get before it makes sense to rent instead of owning? Interest rates would have to get to 13%, and then your lifetime cost is about the same. So we're still in a pretty good spot. Brock, I see you came off mute. Any thoughts on that?
It's interesting because obviously my clientele from a borrowing standpoint are real estate investors. We're seeing a big shift away from fix and flip to like fix and hold now. So a lot of people are taking advantage of the market in a whole, looking to hold real estate long term. And this right here is exactly why you hold real estate long term, to build that kind of wealth. And it just opens up so much more opportunity. And one thing you didn't get, one thing I would say, I own another four rental properties myself, is that the ability to leverage those other assets to buy more assets. Start with 1, go to 1 to 2, 2 to 4, 4 to 8, and you can just continue to leverage those assets to buy new assets.
Yeah, I've got a personal kind of mantra. I buy real estate, never sell it. I have never sold anything I've ever bought. And when I want money out of it, I just do a cash out refi to access all that cash, all that equity, tax free. and I use it to go buy something else. So these days when I buy real estate, I never need to take my own money. I just do a cash out refi, something I've owned for 10 years.
But I'll actually go back in, and you may again talk about this, and that's one of my arguments right now is, let's just say you're just a general homeowner. You got your home, you buy your home, and what are you going to do? Are you going to go sell it to go buy another house to pay a higher interest rate? No. I mean, you're going to hold on to the house, and assuming that there's no big economic catastrophe and you're forced to sell, people are just not going to sell their house. They're going to hold on to it. And I've always made I make this argument where I'm looking a couple of years from now, and people are going to be never selling their house. It's just easier because the rates are so low. They're just going to rent the house out because it's such great income, and that's just going to feed further into the issue of the supply and demand problem that we have.
Yeah, and that's actually a great segue into our macroeconomic update on what's going on economically, really with a focus on real estate. I typically don't like slides with a bunch of words, but I thought this was a valuable one. Mark Fleming, chief economist at First American, said that when the economy uncertain dust settles, already starting to settle a little bit, the uncertainty in the markets, we're certainly not in as uncertain as a place today as we were just 2 months ago. Those buyers and sellers who were on the sideline will jump back in the housing game. Demographic trends support that elevated purchasing demand in the years to come. So it's a question of when, not if. What I'm telling all the clients and investors I work with right now is, as it says here, the uncertainty settles, we get rates back down the fives, and you're going to see a flood of buyers coming back into the market. Inflation has kind of been the key word for the last year or so. We're starting to see that level out a little bit. As I always like to share, inflation, like anyone who didn't see inflation coming, I can't believe the Fed didn't. I called inflation the summer of 2020, Brock. In June, July of 2020, my webinars started using the I word, inflation, and saying you need to buy some assets now because we're going to see some amazing inflation in the next 2 years, more than in our lifetimes. And the only way you get through inflation, at least with the same level of wealth, if not more, is to own assets, not cash. Now, I bought, half of my real estate portfolio my wife and I own, value-wise, we bought in 2020, 2021. That's how much I believed inflation was about to hit. And that real estate portfolio really buoyed up. But inflation was coming, guys, because money supply. Money supply is really what determines inflation. And in 2020, the government gave out money through PPP loans, EIDL loans, all types of unemployment. They just gave out more money than we've ever seen. I mean, see, you get $2,000 just sent to you by a check. And it's that money supply that sear in your imagination, in your brain, this chart, right-hand side, look how much it matches this chart. And this is consumer price index, inflation. Now, one legs the other, inflation legs money supply, because all that money supply comes in, boom, inflation is going to come up. Look what happened with money supply in the last year. It started to flatten out. The government stopped putting so much money into the economy. So what can we predict? Inflation would flatten out. And sure enough, by the end of last year, it started to. That's the story on inflation, guys. Now, a lot of economists are predicting recession. A lot of people mistakenly said there was a recession like 12 months ago in 2022 because GDP fell 2 quarters in a row. GDP falling 2 quarters in a row was the definition of inflation in the 1920s, 30s, 40s, and 50s. But around the 1960s, 1970s, the powers to be said, look, we need a more robust definition of inflation. It's no longer 2 quarters that are negative at GDP. It's now what's going on with the job market, what's going on with imports.
You're referring to recession.
Yeah,
2 quarters
for a recession. So we have not yet hit a recession, at least not one that has been declared. It's more than just 2 negative quarters GDP.
And I'll even caveat that too, because I feel like the media really pushes this narrative. And yes, going into about mid last year, even early last year, gosh, the media was all about, hey, we're definitely going into a recession. You saw the economists coming out, and there's almost this idea that if you're an economist and you disagree with that idea, you're better off just agreeing with the idea that we're going to go into a recession. And, if we don't, hey, great, we don't. But, you just didn't see the facts. You didn't see it wasn't happening. You didn't see anything that would suggest that we were going into a recession. The media really has pulled back from that idea now. coming into 2023.
Yeah, and here's another thing I'll say about the media. Like, I love the people in the media because I got a lot of friends that work in the media, people I know from high school, college, whatever. And I've learned this about people in the media. Most of them have degrees, some of them master's degrees in broadcast journalism.
Yeah.
Very few of them have economic degrees, master's degrees in business, finance, you name it, real estate. So I don't take advice from folks in the media. Now, if there is a recession, great news. I kind of hope there is, because every time there's a recession, we see interest rates go down. And the majority of the time we have recessions, we see home prices, real estate values go up. In fact, for the last 6 recessions, we saw real estate values go up. The one recession where they really dropped was that recession caused by housing. Just not going to happen again. And why do real estate values go up during recessions? It's because of this chart. 100% of the time for the last 4 decades, we hit recessions, mortgage rates fall. So as much as the housing market has been punished by what really has been a pretty strong economy this last year, and when you look at the labor market and whatnot, it's because interest rates have gone up so much, artificial. If we hit something very real, I always like to differentiate between real things in the economy and artificial things that can be easily manipulated. And if we hit a real recession, we'll have an artificial drop in interest rates, and that will help the housing market once again.
Definitely help those that own real estate and have higher rates. I mean, just a quick refinance right there.
There you go.
Now, just to go back, what happened with rents in 2008 to 2011 timeframe in San Diego?
2008 to 2011, they softened a bit, but they held pretty strong, and they came out of the gates like a racehorse, not slowing down. San Diego has been one of the fastest, not just appreciating real estate wise, but also rent wise in the nation. The reason for that is San Diego has one of, if not the lowest vacancy rates in rental property in the nation. We usually sit around 1-2%. 4% vacancy is considered pretty balanced, about 4 to 6, and we're usually around 1% vacancy. Enough time to screen a tenant and put a new one in. A lot of times my clients come to me and say, hey, I want to buy some foreclosure or short sale as well. And I always tell them the best way to buy a foreclosure or a short sale is not to spend time looking for a foreclosure or short sale, but to spend time building a time machine and going back 15 years, because that's when we had foreclosures and short sales. Right now, we're at all-time historical lows when it comes to distressed property. And again, that's because we have some of the best debt, solid borrowers that have borrowed this money over the last decade or so, and they're on those low fixed interest rates. So what's a forecast going into 2023? Well, I'm going to share with you really a collaboration of many different economists and publications on all these forecasts you'll see in the next 5 minutes. The average forecast for real estate values, and I'm not talking industrial, office, retail, stuff we live in, is 1.8%, very modest appreciation. Also keep in mind, these are national numbers I'm giving you. Later in today's webinar, I'll give you some San Diego specific numbers. Only Zelman is predicting negative. Also just as important is where does that fall out on the percentage appreciation? And you can see those anticipating appreciation. This forecast of over 100 economists surveyed, the majority of them are assuming around 3 to 5% appreciation this year, with the really fallout coming between 1% to 10%. The key takeaway here is the majority of folks are forecasting appreciation in real estate even in 2023. Now, if you've ever gone to Vegas, you can still hit 00 green on a roulette wheel. So things can still fall out of the probability and statistics of what one can expect. But when I go to Vegas, I don't bet on green. I usually bet on red or black, right? I play the odds. And in the real life of real estate investment, I also play the odds. And you will never be right 100% of the time about 100% of all your decisions. But if you make your investment bets based on the odds, probability, and statistics, you will be right more often than you're wrong. And as long as you're right more often than you're wrong, and you're not afraid during scary times, you'll end up wealthier than most. And I love probability and statistics. Anyone in business needs to take at least one stats course. Brock, what I like to share next, though, is really going out 3 years.
Okay.
When these same economists are surveyed, even the negative Nancys that were saying, hey, we're going to have negative appreciation this year, they start shifting towards the green. As the years tick on, more and more economists surveyed said we're going to have appreciation in 2024. More said in 2025. More said in 2026 as the economy starts to normalize. And guys, these predictions even take into account a recession happening this year. So let's take a little microscope on California, Southern California, and specifically San Diego. At the end of the day, I already mentioned this, but everything comes down to 2 words: supply and demand. I even kind of make the joke, but it's really not a joke, it's real. Who you ended up marrying comes down to supply and demand. If you go to like a college and you're one guy and there's 100 girls at this college, it opens up your aperture. And same thing, one girl, 100 guys, like supply and demand. It's funny, like when I was in my 20s, all the guys wanted to go to like the bar that all the guys are at. And I'd say, we should go to the bar that all the girls are at. Supply and demand, right? So that's how I met my wife, actually, in Pacific Beach. Right. And guys, it affects everything, though, certainly in economics. As I mentioned with that previous slide, sharing it with you again, we are grossly short on the amount of supply in San Diego relative to the demand. And I also mentioned, along with supply and demand, the value of real estate is heavily based on the value of the economy around that real estate. That is why a house in the middle of nowhere, Kansas, might sell for $100,000. And that same house might sell for $1 million in San Diego because of the economy around it. So I love to study the economy of where I'm investing. And although I've owned some property in other areas, I got the majority of my net worth invested in Southern California real estate. Now, this news in front of you came out just in the last few months. California poised to overtake Germany is the world's 4th economy. And let me be clear, this is California as a state ranked against nations, nations throughout the world. I sometimes meet a lot of people that want to invest out of state, invest out of California. And it blows my mind because there is money around the globe that wishes it could invest in San Diego, in Southern California real estate. Southern California is one of the most attractive places on the globe for high net worth individuals and companies to place their real estate investment money because of what you see in front of you. We have such a robust and growing economy. And here you see it on the chart what the California economy has done in the last 2 decades. Anyone who says California is being run economically bad and our politicians are driving California economically into the ground, they haven't looked at the data. You got to look at the data.
Yeah, and I was gonna, bring that up. I think one of the big, again, discussion points is the number of people that are leaving California right now, especially some of
we'll get to that.
Wealthy. Okay, you're gonna get into that.
So. Oh yeah. Here we go. So let's talk about the number of people. Hey, cut to the punchline. People are moving here, not moving away, because I'm talking about Southern California. Okay, and I'll show you where they're moving away from and where they're moving into. But first of all, again, the value of real estate has everything to do with supply and demand and the value of the economy around that real estate. Guys, the United States economy is worth $22.85 trillion, almost $23 trillion, and over $3.3 trillion of that comes from California. I like investing in the states on here that are the darkest blue. That's where the money at. You ever watch Jerry Maguire? Remember that sign, show me the money? Here you guys go. I am showing you the money, and real estate values will hold and appreciate the most in these darker blue states that have money flowing into them. What I also like to do is break it down. What is the gross domestic product? What is the GDP per capita? This tells me how much money citizens of that state have in their bank accounts. How much are they making per year? I was kind of surprised. My home state of North Dakota pretty dark red up here, meaning GDP is pretty high. Trust me, that's because it's a small state and there's a small fraction of those individuals that own oil. There's a lot of oil that just came out in the last decade in North Dakota, as you know. But California ranks in the top 5 GDP per capita, with the average California resident. You divide our citizenship into our total gross domestic product for a state, that's $85,000 GDP. Where do you find some of the most expensive homes and real estate properties in the United States? Washington, D.C. No surprise, GDP per capita, $226,000. Where else do you find expensive real estate? New York, Massachusetts, Washington State. Got Seattle up there, right? So there's a reason why real estate is worth what it's worth. It's not because there's crazy people. It's not because the world is disorganized. There's a reason. Follow the money, and you see why real estate values are where they're at. Sometimes when I meet these out-of-state investors, they're like, oh, I'm buying something in Arkansas. And I ask them, why are you buying in Arkansas? And they'll say, because it's cheap. And I'll be like, well, do you buy cheap shoes? You don't buy cheap when you want to protect your money. I don't invest my money in the stock market in cheap companies that have very little growth potential. And
I think you hit that right there. Is, what is that value of real estate today? And what is it going to be 10 years from now? It's going to be the same. Okay.
Here's another great one, guys. It's the same country, United States, different colors, green. The darker the green, the more the GDP growth we saw in 2021. And pretty soon we should have 2022 numbers. You see California again, top 5. I would invest in these states that have the darker green because that's where you see the economy. GDP is just a fancy word for the economy. The greatest growth in the economies are those states in the dark green. California, again, 7.8% GDP growth, 2021, ranked number 3 in the nation. So again, if you're watching the media or you're talking to your buddies at the bar or at work and they're saying, our government is running California into the ground, stop listening to them. Don't take any advice from them about anything because they just speak out of the wrong side of their body and they're giving you not good information. Last but not least, United States chart. This shows the percentage GDP for the United States. And you see Texas giving almost 10%, but here we are far and away winning this marathon with a nice healthy lead, 14.8% coming out of California. Now, speaking of California, though, with all this money coming into our state, with all this economic growth in our state, and with San Diego, oh, by the way, guess which city in California had the most GDP growth? San Diego. So California is the state in the entire country with the most GDP growth, most GDP and some of the highest growth. And San Diego has the most growth in the state, meaning you get into this San Diego real estate game, you will end up wealthy over the long run as long as you don't make some stupid decision. But rents are expected to go up $250 per unit over the next year. Why is this happening in San Diego? I always like to answer the why. When I was a kid and my dad told me to do something, I'd say, Dad, why? And he'd say, Patrick, because I told you so. And I always like to tell the why. Learn that in the military. Tell your sailors why, and they'll be more believable of whatever order you just gave them. So why is San Diego growing so much? Why is our real estate values going up? Well, we're a younger, richer, and better educated population here in San Diego. Our median age is younger than the national average. Our income higher than the national average. Education pool larger than the national average. But most importantly, you see in the middle there, we're a forward-looking city built for the 21st century, heavily based around biotech. And you see that on this next graph that shows what is our local economy's economic base made up of. Innovation, tourism, and military are some of our fastest growing driving sectors of our economy. But what I really like to key in here is what you're looking at in front of you is also the same reason I don't invest in Houston. I don't invest in Western North Dakota. I don't invest in Detroit. I don't invest in cities or geographical areas where the economy is heavily based on one segment. The San Diego economy, because that one segment fails, your real estate values get wiped out. But you can see in San Diego, we are a very diverse economy. And most importantly, one of the fastest growing sectors is biotech innovation. And as you see here, going back 200 years, This is called the Kondratyov curve, and it shows cycles of innovation that change mankind, that change civilization forever. Starting out with the steam engine, oh, by the way, in turn, it changed real estate forever. You see, in like the 1800s, over 90% of people lived rural farms outside of cities. Then all of a sudden we got the steam engine, factory manufacturing. Everyone moved into cities in the 1800s. Nobody lived west of the Mississippi until the railroads were built, and that did westward expansion, real estate. Nobody lived in Arizona, Nevada, the Southwest, because it was too hot till electricity, 1900s, air conditioning. Nobody really lived in the suburbs until the mid-1900s, automobile. And the automobile changed Detroit for at least a half a century, and Detroit real estate values. And then what happened next with that fifth wave? Well, that's the CPU, the silicon chip. And again, the powers to be, just like automobiles were built in Detroit, computer systems and silicon chips were built in Silicon Valley, changed real estate prices, San Francisco Bay Area forever. And now we're in that sixth wave, life sciences. And guys, this is why I'm saying there's international money that wants to buy real estate in San Diego and Southern California, because it just so happens San Diego is one of the 3 central cities for biotech and biotech innovation, along with healthcare and all kinds of other life sciences. And Brock, you're probably seeing this. I mean, you're out there in the industry as much as me.
I'm lucky enough to be, I've been married to my wife for now 17 years, and she's in the life sciences business, and the amount of capital that comes in is mind-boggling.
Oh, I got a chart for that. I got a chart for everything.
Okay.
And here it is.
I mean, already
the amount of capital is
with her, and you know, her engagement in the investor side. It's just the amount of capital that's coming into San Diego to chase this industry is astronomical.
Absolutely. And you see that on this chart. So San Diego, for the last 20 years, average venture capital investment in our region has been 1.1 billion, 1.1. In 2021, that number was 9.5 billion. The year before, guys, over 7 billion. We have grown in just 24 months.
Hey, Patrick, I'm going to have you just real quick. I don't mean to stop here. I know there's a lot of questions that are coming in, and we'll connect with you on the questions, but we will share these slides. We'll share this video with all the viewers a day or two after a day or two from now.
Mm-hmm. Yeah, I always share my videos. I don't share my slide deck, but I do share my video. Just the slide deck belongs to company and proprietary, even though we cite all these sources, but I do share the recordings of everything. And I always do Q&A at the end, because a lot of times we answer questions as we go, because I got a chart for everything. But guys, you cannot have this amount of cash infused into any geographical region in such a short period and not have a long-lasting and forever effect on the real estate values. And trust me, folks, these trend lines will continue and continue to increase as San Diego becomes a biotech hub. This takes me back again to my thesis statement. San Diego today is San Francisco 1990s. I tell my clients, and guess what? I am one of my own clients. I buy real estate. I am my own real estate agent. And I tell my clients, you want to get wealthy? You don't got to work for it. All you got to do is go buy some San Francisco real estate 1990 and sit on it for 10 to 20 years, and you'll become a multimillionaire. But because we don't have a time machine, what's the next best thing? Look for a city that is mirroring what happened to San Francisco in the 1990s. And this chart shows you everything that's happening money-wise. Again, follow the money. As you see in this business news article, interest in San Diego biotech real estate has soared, with sales topping $3.4 billion in just biotech real estate in the last 12 months. Again, painting that picture that you can get rich by doing nothing other than buy something and then hold on to it. You don't even got to work. Just buy it, hold on to it. So a couple of billion-dollar examples of what's happening right now, real estate wise in San Diego. And I only include projects that start with a B, at least 1 billion on up. IQHQ, which is going to become San Diego Research and Development District, right in downtown San Diego. You're seeing a renaissance explosion, again, all throughout downtown San Diego. And this $1 billion plus project is going to bring in many six-figure income employees that work in biotech and other tech ventures. This takes up a full 2 city blocks right across the USS Midway. And just across the street over in Seaport Village, there is a large scale development that is being cleared for building. 3.5 billion, guys. This is probably one of the most expensive waterfront projects happening in the United States. It's not going to be up tomorrow because building takes time, but over the next 10 to 15 years, we'll see almost what looks like a Seattle Space Needle being built in the entire Seaport Village area, redeveloped with new office space, retail, hotels, you name it. All of this further fueling not just our tourism, but the biotech growth and the money coming into San Diego. SDSU in Mission Valley is building what they could call their innovation district, just like Berkeley and Cal had many of their tech companies connected to the local universities. That too will happen in San Diego with an incubator being built through SDSU and a lot of new companies that are going to become national, that'll probably become Fortune 500 companies, are going to get spawned through San Diego. Here's a big project, another $4 billion one up and down Mission Valley. It's called Mission Valley's Riverwalk area. Right now, they're already under development with 930 apartment homes, 75,000 retail shops. But over 15 years, the next decade and a half, you'll see over 4,000 new housing units and over 150,000 square feet of retail built up and down the Mission Valley area, where there currently is and was a golf course. Some of the biggest news in the last year or so was Apple. So Apple is growing by over 20,000 jobs in the next half a decade, and over a quarter of those jobs are going to be based right here in San Diego. Over 5,000 new Apple employees, because as Apple announced last year, San Diego is going to become a principal engineering hub for Apple. And they made that announcement not by leasing buildings in San Diego, but by buying buildings in San Diego. When a company buys instead of lease, you know they're there for good. And Apple spent almost $500 million buying the old HP 67-acre campus to build a brand new Apple campus in San Diego.
Patrick, what's interesting is my office is just to the right of right here.
You know,
the amount of number. So you have to realize that a lot of these buildings were vacant for a couple of years, especially those HP buildings, as HP was pulling back their business in Rancho Bernardo. It has completely revolutionized this area with all of these, with Apple coming in, redoing the buildings and bringing in all their employees into this area.
You know, and this is a good example of why I always tell people, you want to know what's going to happen to the value of real estate? Don't look at real estate. Look at everything else around that real estate. Look at the economy, because who buys real estate? People, not dogs, not cats, not trees, people. So you need to look what's happening with the people and the amount of money coming into an area, and that will tell you what's going to happen to real estate. With biotech and healthcare, UCSD Hillcrest, one of the top hospitals in the nation is UCSD, and they're building a brand new $2.5 billion multi-phased hospital complex throughout Hillcrest. That old 1960s hospital already getting demoed down, and just across the street, 4 blocks away, you're going to see Scripps Mercy build a brand new $1 billion hospital. Down in our South Bay area, you've got west side of Chula Vista. Now, this has been like 20 years in the making, guys, and it's finally happening. They're building the Chula Vista Bayfront development, a $2.8 billion development that's going to bring in thousands of jobs, including long-term jobs, in multiples of money, not just during the project, but also when it's done through tourism, with a convention center that is second in size, only second to the downtown San Diego Convention Center, because we just don't have enough space right now for all the tourists, all the conventions, and all the businesses coming in. This is going to help open the door to the South Bay, not just Chula Vista, but opening the door to IIB, to Otay. And speaking of Otay, Amazon, another big tech company, built their largest facility in the entire state of California right here in San Diego, down in the Otay Mesa area, an over 4 million square foot Amazon facility. You can't talk about San Diego without talking about the military, of course, near and dear to my heart. And while I was on active duty, the US military and Washington, D.C. started doing something called the Pacific Pivot. Our concerns are no longer Nazi Germany like they were in the mid-1900s. Our concerns now are China, Taiwan, Southeast Asia. And with that, we have pivoted many of our Atlantic Ocean forces to the Pacific Ocean. And oh, by the way, San Diego is home to Third Fleet. We have the largest concentration of military in the world right here in San Diego, and that concentration is only growing. We think of defense spending. San Diego, it receives more defense money than anywhere else in the nation, but for one other area, Fairfax, Virginia. But money pours into here, billions of dollars year over year. But what a lot of people don't think about isn't just the DoD money, but the skilled workforce that comes out of the DoD every year. Every year, over 15,000 military veterans get off active duty in San Diego, and half of them stay in our region. I'm a good example of that, and there's many copies of me of people that got out, highly trained, and stayed here in San Diego. What you're looking at now is just an example of that military growth with the Silver Strand military training complex that was recently developed down in the Imperial Beach area. And by the way, Brock, a lot of these areas I'm showing, I own real estate in these areas because I'm a firm believer. If you can buy real estate near big time development, billion-dollar development, you'll become wealthy. I bought real estate downtown. I bought real estate in IB with all this going on. I bought a property in Hillcrest just 2 years ago, 2.5 years ago. And it's prime for development. A lot of times I love the 2 to 4 unit market because a lot of times real estate agents don't understand investment real estate that work in the 2 to 4 unit market because it's considered residential. They don't understand the zoning. And I feel sorry for their clients. But when you get one of these,
it's funny you bring up Imperial Beach because that's actually a hot spot that we do a lot of our financing in. People are buying up. A couple of years back, it was more of the vacation rental stuff. But what's really become super popular now is just ADUs. So you're buying up single family homes on large lots and be able to add additional units. So they can go into these neighborhoods that do have these smaller homes and be able to put additional units onto there. So it's interesting that you bring up Imperial Beach because that's been a hot spot for us.
And that's where I bought that fourplex for 1.35 million during the pandemic, right at the start. And it's worth well over 2 million now. The Hillcrest, a lot of people didn't know about the development happening there. The real estate agent selling the property I bought there, it was a duplex. And that agent didn't realize the density that could go on to it. So again, I feel bad for their client, but who you work with matters. You work with someone who's not educated in their profession. Sorry if you lose money, but I bought that parcel for $850,000 and I just got an offer for nearly $2 million from a developer. You make money by making educated decisions, the big money. So again, back to San Diego, what's happening here? Number 3 destination for people to move, looking to move to a different city. And as we see here, more people than ever, almost 33.9% of people are looking to move outside of their area to a different city. And oh, by the way, San Diego ranks number 3. So anyone who says people are moving out of San Diego, all right, here's some national data for you. We are number 3 on the search list. And everyone's on like Zillow or Redfin searching where they want to move. Over a third of people want to move out of where they are now to a new city. And you can see here, where are people moving to? Miami, number 1, Sacramento, number 2, San Diego, number 3. California takes 2 of the top 3 spots on our top 10 list here, folks.
Oh, that's interesting.
So, yeah, right. So people are moving into San Diego. They're moving into SoCal. They're moving into California. And I also like to highlight, it doesn't matter how many people move to your city. It matters who moves to your city. Because you could have 5 million people that are super, super poor move to San Diego, and that's not going to affect our home prices because they can't buy homes and they probably can't rent. So it's going to hurt our housing. It's going to hurt our homeless problem. Now, when you look, everyone's migrating to Texas. Everyone's moving to Texas. Yeah, there are a lot of people moving there, but guess who's moving there? People that can't afford San Diego. I don't want to call them poor, but I will say they can't afford San Diego. That's why they're moving to Texas. So you're not going to see this huge bump in Texas home prices. Who's moving to San Diego? People that can afford San Diego. Who's moving out of San Diego? Folks that can't. And this chart shows you exactly who. It's tech talent. Now, this was an article produced by LinkedIn, and no company on planet Earth knows better than LinkedIn knows who's moving where. Why is that? Because LinkedIn knows where you live, they know your education, and they know your job history. LinkedIn is like every other tech company, they sell your data. And with that, LinkedIn published that there is no city growing its tech talent faster than San Diego. Again, this.
Well, I think, I don't know, maybe you can highlight what we saw just last year was a lot of people from the Bay Area moving down to San Diego. Yeah, even in our neighborhood, we saw it, and driving up those home prices. I think I was talking to my wife yesterday, and I know that Apple, you'd mentioned that Apple was buying up, a lot of facilities, a lot of space down here. And I think they're looking for more tech talent and moving their tech talent to where they think they want to live.
Speaking of where people are moving from into San Diego, some of the top places that we're gaining our imported people from are Seattle, San Francisco, Los Angeles, and New England. And when I saw that, I was like, New England, what's that all about? Well, the West Coast people, it's all that tech talent moving in here. And New England, well, what does New England got, guys? It's got some of the best colleges in the world. And it's all these brand new grads from Harvard and MIT and Brown University that are moving here to San Diego. But guess where most of our transplants move here from? The state that sends us more people than any other state in the union is Texas. Now, everyone says everyone's moving to Texas. Everyone's moving from California to Texas. And yeah, when people leave California, a lot of them go to Texas because they like that warm weather. But guess what? More people move to California from Texas than any other state. And I always like to say, and this might come off as offensive, but we are doing a human capital exchange of people with Texas. We are sending Texas the people who can't afford San Diego. We're sending them the people that aren't getting the six-figure jobs in San Diego. That's who we're sending to Texas. And Texas is sending to us their highly educated workforce. They're sending us their highly compensated workforce. So there's just a human capital exchange going on between California and Texas right now. But when you hear the headlines that everyone's moving away from California, what is that all about? People are moving away from Northern California, not Southern California. The chart in front of you shows the percentage change of populations throughout the United States. Now, the green areas are areas in the US that are gaining population. And this came out of the 2020 census. The orange areas are areas that are losing population. So as a real estate investor, what does this tell me? It tells me don't invest anywhere that's orange because people are leaving those areas. Invest areas that are green. Now, this chart shows percentage change. So you see, like, again, my home state, Western North Dakota, really dark green. So you might think, well, you should invest there. Guys, Western North Dakota has like 50,000 people, 60,000, not many people living in it. So you gain 6,000 people, and that's a huge percentage change. What I like to look at is the raw data, the raw numbers. Which areas by the numbers are growing with the most people? Boom, here it is. And the darker green, the higher the population change over the last decade. And you see it doesn't get any darker green than San Diego County. In fact, most of Southern California up to the Bay Area is green, indicating our population is growing there. So where did we lose some people? Up in Northern California. That's, usually that's not where our tech hubs are. That's not where our biotech hubs. That's where you see more of the yellow. If I was an investor, I would invest on this map areas that are green. You see Florida, remember Miami, mentioned that. You see Texas, and we had a few Texas areas where populations are migrating to, but they're not going out there to buy like a cabin in the woods or a ranch in the middle of nowhere. People are moving urban. And when they move to Texas, they move to Florida, they move to California, they're moving urban. Again, this is why, hey, you want to invest out of state, you want to buy some cheap real estate, go have at it. You're just not going to become that wealthy doing so. Invest where people are moving, where jobs are growing, where innovation is happening. And as we see in the chart in front of us going back 50 years and projected out the next 50 years, our country is becoming more and more urban and less rural, with that blue line, the urban population, continuing to grow. So is San Diego cheap? Guys, I came from North Dakota. In North Dakota, $500,000 gets you a mansion. In San Diego, $500,000 gets you a condo. So is San Diego cheap? Ask me, this guy. Well, it's a lot of money compared to North Dakota, but there's a reason for that. The economy here, the population here, the growth here is unlike what you will find just about anywhere else in the globe. So what you got to ask yourself is San Diego or Southern California cheap compared to North Dakota, compared to Kansas? If you're going to compare it that way, why not just compare it to like Bangladesh, compare it to Thailand, right? You got to compare things to what they will be. As an investor, you got to ask yourself, is a stock cheap compared to what it will be? Not is Microsoft stock cheap compared to Hardee's or McDonald's, compared to what it should and will be. That's how we buy stocks when we're intelligent investors. And that's how we should buy real estate when we're intelligent investors. So I ask myself, is San Diego cheap compared to what it will be? And the answer is absolutely unequivocally yes. Yeah. Because based on the growth of our region, we have a lot of growth ahead of us, folks. Mm. And I value real estate the same way I value a stock. What's the growth of that company? What's happening internally to it? San Diego is probably some of the most undervalued real estate in the globe. Now, I've been saying this since 2016, since I started getting in brokerage. And for those of you that have been following me since then, I have not changed the tune I whistle because I look at the data, I look at long-term trends, and the rooster came home to nest within the last couple of years, and we started to see San Diego appreciate even faster than LA and San Francisco. The chart in front of you simply shows you a little over half a decade of appreciation rates of these three major cities in California. And San Diego's kind of always been on trend, but San Francisco has been the poster child of appreciation. And for the first time in my lifetime, within the last year or two, San Diego has overlapped San Francisco, and we are now the fastest appreciating city in California. Back to what Brock mentioned, back to what I mentioned, supply. What is going on with the supply, guys? It's not a San Diego phenomena. It's not a California phenomena. It's a national phenomena. Coming out of the Great Recession, we just didn't build enough as human beings. And we didn't because lenders were scared, developers were scared. Half of them went out in business in 2009. So over the decade of 2010 to 19, we built approximately half the amount of housing units we do as a country in any given decade. And when you zoom in on this and you look at just San Diego, the story is the same. Now, going back again, 2 decades to 2023, we need to produce over 21,000 housing units per year to meet our growing demand and to fill in that deficit. We are averaging 9,000, guys. We are building less than half of what we need to build. Now, I don't know about you, but if I own a bar and I got 20 people walking in my front door and I only got 10 cans of beer, I'm going to sell that beer for a lot of money. And the same thing is happening in the housing market and long-term trend. It will continue to. What happened to housing in the last month? What happened to housing in the last 6 months? What happened to housing in the last 12 months? Here's the answer. Who cares? Everything that's happening in housing in the last month or 2 months or the next month or two, it's all short-term. It's not going to change your life. You got to look at long-term trends of a company or a housing market if you're investing in a company or if you're investing in a housing market. Look at these long-term trends. We just don't have the supply. And I also love to overlap it with this chart. I've already talked about the biotech boom. The orange line is the change in household growth in San Diego. Oh, by the way, anyone who says folks are moving out of San Diego, stop listening to them. They don't know what they're talking about. Let's look back 40 years. Household growth in San Diego, the amount of families, individuals, just housing units needed, have always been positive. They've never been in the negative, all the way back to 1981, the year I was born. Now, some years did we have slower household growth than others? Absolutely, but never negative. And you can see coinciding with 2017, 2018, that's when the biotech boom began. That was the infancy of it. And that's when our household growth really started booming again. It overlaps with what I said 10 minutes ago. Doesn't matter how many people move in your region. It matters who moves into that region. And all these people moving in now are six-figure, master's degree, biotech type of flavor human beings. And it unfortunately overlaps right when our amount of housing units being added started to fall off the edge of the cliff. We are not building enough, blue line, not building enough to compensate and house the orange line, all the people moving in here. That's why real estate owners in San Diego and Southern California are going to become wealthy. Real estate owners that are landlords are going to become even wealthier because those rent checks are going to keep going up. Property values keep going up. There's probably no better wealth building opportunity in the globe right now for your average human being than buying San Diego real estate and holding it over the long run. The housing phenomena are really the deficit of it. Again, it's nationwide. And as we saw in Forbes, as we saw in the Wall Street Journal, it's going to take over a decade just to get back to where we need to be. And that is if we do record amounts of construction. Trust me, we're not doing records amount of construction. We're doing some of the lowest amounts of construction ever in the last decades. Certainly in San Diego, where we need over 20,000 units a year, and we're just building 9,000. So if we need record construction to fill the housing deficit, and it would take 10 years, and we're not doing record construction, what does that tell you? It tells you we are not going to fix the housing deficit. We're just not. So real estate values will hold, rents will keep going up. And unfortunately, the least amount of homes we've ever built in my lifetime over any decade was this last decade and your lifetime is coinciding and intersecting with the largest generation of American history hitting first-time home buying years. And that is millennials hitting their late 20s, early 30s. And those millennials aging into their 30s now, getting married, having babies, they need to buy homes, and we just don't have it. So I showed you the supply side of the equation. Now I'm showing you the demand side of the equation. And you can see the demand is at an all-time peak. Supply is at an all-time trough. So what happens to the value of anything? It hits high levels. And we can see it in the numbers going back year over year. The red line is a percentage of buyers in the United States that were millennials. In 2020, for the first time ever, over 50% of buyers were millennials. And that number keeps on growing year over year. And it will probably for the next decade or so as millennials age into their 30s and 40s. How does that coincide with San Diego? Well, guys, San Diego is a millennial city. If you look at demographically, 21.7% of United States citizens are millennials. California has more millennials than your national average at 23.4%, and San Diego has the most of any other city up and down the coast here at 25.1%. Over a quarter of San Diego's population is millennials, and guys, it's millennials buying real estate. So what's going to happen to real estate values in San Diego? Probably see more appreciation than you will throughout California and the nation. As we did in the previous slide, we already saw San Diego is appreciating faster than all these other cities. Well, I hear this word now and then, bubble. So I got to bring up the word, the B word. Bubble is not a bubble. It's simply a lack of supply. Lawrence Young, the chief economist of National Association of Realtors. I understand economics pretty well. This guy probably understands it even better. And he agrees it is not a bubble. Simply a lack of supply we're having right now. We had some artificial changes in interest rates. They'll come back down and you'll see the market just go bananas again and prices skyrocket again. But why is it not a bubble? Why? Guys, just because values are high doesn't mean a bubble. But again, most people don't have advanced degrees in finance or economics. So they say, oh my gosh, that's super expensive. Must be a bubble. Let me ask you this. Is there a bubble in the Rolls-Royce car market? No, but they cost a lot. Is there a bubble in the Ferrari market? No, but they cost a lot. Just because something costs a lot doesn't mean it's a bubble. Bubbles are, by definition, when something is artificially inflated and it ends up in a situation where there's far more supply than there is demand. That's a bubble. The only reason you hear the people say this word bubble is because they got 10-year memories thinking of 2006 and 7. Now, there was a bubble back then because artificially we inflated the housing market by giving loans to people who shouldn't get loans. And you can see here the amount of people, the amount of loans were given to folks with credit scores below a 620 was just unimaginable before 2007. And I mentioned previously in today's conversation that we have really tightened up our lending standards to the extent that the debt today is good debt for the majority of homes out there. California real estate, guys, as I mentioned earlier, still a great idea. Not a good idea, great idea to get into it. So much data I'm sharing with you. And I love how everything ties into real estate, including this. Let's look at our population. 1986, I was 5 years old in 86. And in 1986, our population was 27 million people. And today it's 39 million people, just over. Yet our building permits in 1986, 256,000 building permits that year. And in 2021, less than half that amount, 115,000. You don't need to be a mathematician to know that when you have a much larger population, you need more building permits coming through the cities, and we just don't have that happening. So what are experts saying about home prices in the foreseeable future? Again, another chief economist, this time from Redfin. For those bearish folks eagerly awaiting for home prices to crash, don't hold your breath. You're going to keep on waiting. Because as much as demand is pulling back, again, because interest rates went up, something artificial, supply pulled back as well, reducing any downward pressure on prices in the short run. So you're just not going to see that massive crash. Over 90% again of homeowners in San Diego have an interest rate below 4%. They're not going to sell. They might not love their house, but they love their interest rate. So you're just not going to see a massive amount of inventory come on the market the way we saw in 2006, 7, 8, and 9. That's why there's not going to be a crash. What are they predicting here on mortgage rates? Well, as we go through the next 4 quarters, and we're already seeing this play out, guys, and we average out these predictions, Freddie Mac, Fannie Mae, MBA, and NAR, the average is, hey, 6.48 Q1, slowly falling to 6.2, then 6.1, then 5. Guys, I'm telling you, if you want to buy real estate, get it done before we hit the mid 5s. Because once we hit the mid 5s, there should be a line out the door at every property wanting to put an offer on that house or that apartment building, whatever it is you're buying. Once we hit the mid 5s, as an investor, buy now, refi later, but buy when competition is low. Because what's going to happen when we hit the mid 5s and all of a sudden we're back to where there's 10 offers on one house? You see property values go back up again and go back up fast like we did before. So should you buy a home, or if you're an investor, should you buy, you name it, an apartment, something to buy and hold? Again, I'll never tell you what's going to happen in the next month or two. Can't predict short-term futures, but using trend lines, we can predict long-term trends. What I share with all my clients who are on the fence, should I buy or should I not? I share with them another fact. Homeowners create much more generational wealth than renters can ever imagine to do. Now, throughout the United States, going back 4 decades, we see that the average family that is a renter has a net worth of under $10,000, whereas the average family that owns real estate has a net worth of over $250,000. Now, here in San Diego, we live in a region where real estate values are much higher than other areas. Again, why I feel we are blessed to live in an area where a condo costs $500,000, because you cannot build generational wealth much above $250,000 unless you live in a market like San Diego, where you can buy a $500,000 condo today, and in 30 years it's worth $3 million. And how does that happen? It happens because our average rate of appreciation here, going back 35 years, is 6% year over year. You can have a net worth of $250,000 if you own a house and pay it off in 30 years in the Midwest. You can have a net worth in the millions if you own a house and you pay it off in 30 years in Southern California. Median asking rents, we all know rents keep going up. So this is a great chart to look at if you're a landlord. It's a scary chart to look at if you're a renter. As much as I can say, over the long term, home prices and real estate values go up. Same with rents. Now, do they dip down every now and then? Yeah, look at 2004, look at 2011, look at, mid-90s. But over the long term, guys, make your bets based on long-term trends. When you get someone who counts card at blackjack, someone who is a professional Vegas gambler or anything, they make their bets not based on what happened on the last hand. Never make a bet based on what happened on the last hand of cards. Make your bets based on long-term trends. And just comparing it back to the bubble that was 06 and 07, again, you got to have more supply than you got demand. And we can see here the amount of active inventory in 2006 and 2007 in San Diego County. That's your purple and green line. And how many days on market homes sat. And when we look at active inventory and how many days on market homes sat in 2021 and just this last year, 2022, we see that homes are selling in 90 days or less. You really don't start to get to that bubble territory where homes crash, home prices crash until you get over 200 days on market, and we're not even halfway there yet. So again, back to that thesis statement, San Diego today is San Francisco circa 1990. You want to become wealthy? Here's the cool thing. You don't have to work hard. Working hard is great. Working hard will pay your bills. You want to become wealthy, you need to make well-informed, intelligent investment decisions, make the right investments in the right areas. And I'm telling you, if you would have bought San Francisco real estate in the 90s and held on to it, you'd be wealthy. Can't take you back to San Francisco. But I can show you what San Diego looks like today, as I did over the last 90 minutes, and how that correlates to San Francisco of 2 or 3 decades ago. And I always like to share, you know, my dad taught economics and he taught history. He's a high school teacher. So maybe that's why I am including history in this economic presentation. But in the 1840s, we had a California gold rush. That's how the San Francisco 49ers got their name. And that's why they got gold on their helmet. Maybe they got red because people killed each other for gold. But 1849, there was gold rush out here in California. Guys, I can't take you back to 1849, but there is still a gold rush happening here in California, making millionaires. Guys, I have so many of my clients, some of them in their 20s and 30s. When I met them, they were not millionaires. Today, they are, because they made the right investment decisions with real estate. And there is a gold rush happening right now. It just happens to not be in the mountains of Julian. It's on the streets of Southern California cities. And people are becoming millionaires by getting into that game. I'll end it on this note. I used to run. I was never that good at running. And I always got scared when I got up to the starting line, because that's the scariest line to get up to. But everybody I learned wants to cross the finish line. But remember, in order to cross that finish line, you must first cross the starting line. And Brock, probably like me, you have met all kinds of people that want to invest in real estate. They want to buy real estate. We see them at the meetups now and then, and they got like these fantasies, and the only thing that stops them is themselves. And they want to get to that finish line, and that's all they see, but they're too afraid to cross the starting line and make a decision. And that's why in my business of brokerage, I decided I'm gonna approach this business not from a sales perspective, but an educational perspective. Because I learned if I educate my clients, if I educate consumers, it makes stepping up to that starting line a little bit less scary when you have the data and the knowledge to know what you're doing. And with that, I'll end it by saying what I mentioned earlier. Who you work with matters. I've known Brock for some years, very intelligent guy. I know he knows his real estate inside out. When I built my real estate, I surrounded myself with professionals, educated folks that understand real estate, not sales, but understand real estate. And what you see in front of you there is my team, Kappel Realty Group. And if you ever have any brokerage needs, maybe you got to buy a condo, you got to sell a house, whatever, you name it, you need some real estate needs, and it happens to be within the brokerage realm, reach out to my team and we'll be more than happy to assist you from an educational approach. Again, the best way to get a hold of me is my email, patrick.kappel@compass.com. And if you want a recording of this webinar, Brock, I think you said that you're able to send that out.
Go ahead and send out that recording.
Perfect.
So, Patrick, this is why I have you on. The amount of data that you can provide to back up your statements is unbelievable. And you know, the takeaways that I had, number one, supply and demand. And that's something that if I could get on the roof of every house and just yell that out, is, you know, that's why we focus our lending here in the Southern California market. It's because you'll never overcome the supply and demand issue here. And what that does is really buffer us, the Southern California market, from kind of macroeconomic issues that happen here in the United States. And so I think everything you just provided, all that evidence just demonstrates to I think the basic concept of supply and demand. And then also the focal points of the industries that are coming into San Diego, from life sciences to technology. It's just going to further boost values of real estate in almost every sector of property here in San Diego. So thanks again for sharing your information. I look forward to seeing you at the next SDCIA event. Oh, I'm going to have you throw you off.
Sorry, I see I was on mute. Yeah, any questions that I missed? I see there is one. Is it better to buy a condo now or wait and buy a duplex? I always tell people the best property to buy is the one you can buy now.
Yeah.
Because again, it goes back to that starting line. You're going to wait for a duplex, then you're going to wait for a fourplex, then you're going to wait till you get married, then you're going to wait till you have that kid, then you're going to wait till you get the job promoted. You just wait, you never buy a house. The first property I ever bought in my life was a crappy little condo in Bonita, and it was cheap. It needed renovated. It wasn't ideal. And everyone asked me, why are you living in Bonita? You should live in PB. I was in my 20s. And I say, it's because of what I can afford. It's what I could afford at the time. The best first property to buy is the property you can afford. It's better than waiting for the property you really want. Right now, I live in the house I want, but it took me 15 to 20 years to get there. The first place you buy isn't the one you want. It's the one you can get. And from that, like Brock, you mentioned, you can build that equity, do the cash out refis, and you scale up. But you got to start somewhere.
Gosh, Patrick, I mean, like you and I follow the same kind of trend line. I bought my first condo when I was about 22 in Fremont, California, which is kind of the East Bay of the Bay Area. And literally it's been I've held on to it. It's been the best investment I ever made. I can't tell you how many times I've pulled cash out to buy another house. And I've always just held on to the houses that I bought and bought a new house. So, gosh, yeah, make really good points. So it looks like another question popped up here. Awesome conclusion, Patrick. Well done. And then another question, don't wait to buy real estate and wait.
Yep.
Good
That's
point.
A very common thing.
That's a good point. So I'm going to do just a quick overview of TaliMar, finish this off. I'm going to go ahead and share my screen. And we will go to my PowerPoint presentation. So as I mentioned earlier, TaliMar Financial, we do run a mortgage fund. We work with high net worth investors to invest in the fund. What that fund does is lends money out to real estate investors who are looking to buy real estate, either fix it up and flip it, look for bridge loans to purchase or refinance the property. A lot of borrowers, real estate investors come to TaliMar Financial for their financing simply because the banks can't fund them. Either it's the type of transaction that they're looking to do, like a fix and flip, a bank won't fund that type of loan, or they need to close quickly, especially in today's dynamic market. Borrowers need to move fast to jump on opportunities. That's why they come to private lenders like TaliMar Financial. You can invest in the fund. When you invest in the fund, you invest in a diversified pool of mortgages, and you earn monthly income. That income you can take distributions or reinvest those distributions and earn compounded interest over time. All of our loans that we're funding obviously are secured on residential or commercial real estate, and primarily here in the Southern California market. So if you're interested in learning more about investing in the mortgage fund, maybe you're investing in trust deeds right now and you're just sick of turning through trust deeds a lot, go ahead and give our team a call. I'll be more than happy to provide you more information on the mortgage fund. And for those people that are on the webinar today that are real estate investors and out there buying real estate, well, there's no better real estate lender that you can go to for your hard money lending needs. If it's a fix and flip loan, fix and hold loan, bridge loan, what have you, you're a real estate investor, a mortgage broker, or a real estate agent, and conventional financing isn't really an option, give us a call. We're a direct lender. We can close loans super quick, and we provide very aggressive financing. So give us a call. And with that, I want to say thank you very much for listening. Patrick, again, I can't say thanks enough for coming on and speaking to some of our clients about where the housing market is going here in Southern California.
Very welcome. And one thing I want to add, Brock, and you didn't ask me to say this, but it's really to support what you do, is a lot of consumers think it's good to pay off your mortgage, right?
Yep.
And we're talking to people out there that might own. Me personally, I hope I never pay off my mortgages, never, ever, ever, because I can borrow the money pretty cheap, and I do cash out refis, and then I go invest in syndications with the cash out refi. I go invest in a new deal I buy, or I invest in things like what you have,
Yep.
TaliMar Financial, because if I can do a cash out refi, borrow money at 5% or 4% or what have you, and invest it at 7.75%, that's arbitrage. I'm making money off money. That's how you build wealth. And I see that you're like first position trustee and all that, 75% LTV in a SoCal, which is a relatively safe, stable market. So it's very, nothing's 100% guaranteed, but that's a pretty good protected investment for money. And you might as well do arbitrage cash out refis to invest in stuff like this.
And then I have to end it off. Obviously, Patrick and I met at the San Diego Creative Investor Association, SDCIA. It's one of the biggest real estate networking events here in the San Diego market. If you're interested to learn more or attend these events, great way to network with other investors like Patrick and his team. Go to sdcia.com, sign up for the next event. It's, I believe it's in early February. So again, thanks for tuning in. Thanks for listening to us. And I look forward to hearing from you.